The rising three methods pattern is a bullish continuation pattern found in candlestick charting, traditionally associated with the stock market, but applicable across various financial markets. This pattern signals that an existing upward trend is likely to continue after a brief pause. It consists of 5 candles, starting with a large bullish candle, followed by 3 smaller bearish candles that stay within the range of the first candle, and finally, a closing bullish candle that surpasses the closing of the first candle. The significance of the rising three methods pattern lies in its ability to indicate the continuation of an uptrend. It suggests that despite a slight retracement or consolidation within the trend, the buying pressure remains strong enough to resume the previous upward movement. This insight can be invaluable for traders looking to capitalize on the momentum or to confirm their bullish outlook on a stock or asset. We encourage viewers to practice identifying the rising three methods pattern in their trading activities. Familiarity with this pattern can enhance your ability to make informed trading decisions based on the likelihood of trend continuation. Start by examining historical charts to spot occurrences of this pattern and observe how the market responded in each case. This exercise will help develop the skills needed to recognize and interpret the pattern in real-time market conditions. In conclusion, continuous learning and adaptability are crucial in the dynamic world of trading. The financial markets are ever-changing, and strategies that work today may not be as effective tomorrow. Staying informed about different technical analysis patterns, like the rising three methods, and regularly refining your trading approach are key steps in becoming a more proficient and successful trader. Keep an open mind, be willing to learn from experience, and remember that mastering the markets is a journey, not a destination. Candlestick patterns play a crucial role in technical analysis, serving as tools to enable traders and investors to interpret market sentiments and forecast potential price movements with greater accuracy. Originating from Japan over centuries ago, these patterns have gained global recognition for their efficiency in predicting short-term price movements based on historical price data. By visually representing the open, high, low, and close prices within specific time frames, they offer a pictorial summary of market trends and potential reversals. Among the myriad of candlestick patterns, the falling three methods stands out as a bearish continuation pattern. It is a formation that typically emerges during a downtrend, signaling the persistence of the prevailing negative sentiment among the market participants. This pattern is characterized by a long bearish candlestick, followed by a series of 3 smaller ascending candlesticks that stay within the range of the first large bearish candle. It concludes with another long bearish candle that moves in the direction of the original downtrend, effectively resuming the downward trajectory of the asset's price. The falling three methods pattern is symbolic of a temporary pause or consolidation in the market, suggesting that despite the short-lived attempt to push the price upwards, sellers remain dominant and the downtrend is likely to continue. Understanding the falling three methods and other candlestick patterns can serve as a beneficial strategy for market participants. By merging historical price action with current market behavior, traders can make more informed decisions, fine-tuning their strategies to capitalize on the emerging trends or to protect their investments from potential downturns. The falling three methods is a candlestick pattern that serves as an indicator of continued bearish momentum in the market. This pattern typically unfolds over 5 candlesticks within a downtrend. The initial candlestick is a long, black one that signifies a strong selling day, followed by 3 small-bodied candlesticks. These 3 small ones, which can be either black or white, represent a brief pause or consolidation in the market. They do not push the market beyond the low of the first long black candle. The 5th and final candlestick is another long, black one that closes at a new low, confirming the bearish momentum and suggesting that the downtrend is likely to continue. To visualize the following 3 methods without actual charts, imagine a series of 5 candlesticks on a stock chart. The first candlestick is tall and black, resembling a tower. This tower is followed by 3 smaller candlesticks, which could look a bit like steps that hover without descending beneath the tower's base. These 3 are then followed by another tall black tower, similar to the first, but ending even lower than the initial tower's base. This formation, seen in various market scenarios, acts as a signal to traders that despite the market's brief pause or sideways movement, the overall bearish sentiment remains strong and the price is likely to continue dropping. Understanding and identifying this pattern can help traders and investors make informed decisions, as it provides a visual representation of market sentiment and potential future price movements. The following 3 methods is a bearish continuation pattern found on candlestick charts, often signaling the continuation of a downtrend. To identify this pattern, look for specific features in its shape, size, color, and the sequence of the candles. First, the pattern begins with a long black candle, indicating a strong initial move down. This candle is followed by 3 small body candles that generally trend upwards. These can be either black or white, but must not exceed the range of the first long black candle. It's crucial that these middle candles stay within the high-low range established by the first candle. Finally, the pattern concludes with another long black candle, closing at a new low and confirming the bearish continuation. The colors black and white are used here to denote candles. Black represents a closing price lower than the opening price, while white signifies a closing price higher than the opening price, reflecting traditional candlestick charting colors. The importance of the pattern's position within an existing downtrend cannot be understated for accurate interpretation. The following 3 methods pattern should emerge during a clear downtrend. Its recognition adds weight to the prediction that the trend will continue downward. This context is crucial because if the pattern appears outside of a downtrend, its reliability diminishes significantly. Visual examples from chart instances can vividly showcase the following 3 methods pattern across different market conditions. One might visualize a steep downwards trend followed by a slight retracement with the 3 small candles, echoing like a brief hesitation in a fast-flowing stream before plunging further downstream with the final long black candle. This imagery helps anchor the concept of the pattern as a brief pause in a prevailing downtrend before a resumption of the downward move. In essence, being able to identify and understand the following 3 methods pattern within the correct market context can provide valuable insights into the continuation of bearish trends, allowing investors to make informed decisions based on technical analysis. The following 3 methods pattern is a technical analysis concept that sheds light on the prevailing sentiment in the market, particularly among traders. This pattern emerges in a downtrend and includes a long bearish candlestick, followed by 3 smaller ascending candlesticks, and concludes with another long bearish candlestick. This configuration suggests a brief consolidation period within a dominant downward trend. When traders observe the following three methods, it indicates that despite a temporary pause or minor upward correction in prices, the overall confidence in the bearish trend remains strong. The initial long bearish candlestick sets the stage, suggesting that sellers are in control. The three small ascending candlesticks that follow represent a slight pushback from the buyers, yet this pushback is not strong enough to reverse the trend. Finally, the appearance of another long bearish candlestick confirms the seller's dominance and the market's inclination to continue the downtrend. This pattern reflects the psychology of traders during periods of consolidation. Even though there might be short-lived optimism causing prices to tick upwards, the conviction among sellers that the downward trend will prevail leads them to resume selling, which drives the prices down again. The brief pause in selling, therefore, serves as a momentary gathering of strength before the downtrend resumes with renewed vigor. In essence, the following three methods pattern highlights a controlled and strategic retreat by bearish traders, rather than a shift in the market's overall direction. This insight into market sentiment and trader psychology can be invaluable for investors looking to understand the dynamics of bearish trends and the likelihood of their continuation. The following three methods pattern is a technical analysis tool used predominantly to identify the continuation of a bearish market trend. It is characterized by a large bearish candle, followed by 3 or 4 smaller ascending candles within the range of the first candle, and concluded with another large bearish candle. This formation is a strong indicator that the current downtrend is likely to continue. Evidence against interpreting the following three methods as a reversal pattern comes from its very structure and market psychology. The initial large bearish candle signifies a strong move downward, which suggests that bears are in control. The following small bullish candles represent a temporary pause or consolidation rather than a change in market sentiment. Typically, these small candles do not breach the high of the first bearish candle, indicating that buying pressure is weak. The concluding large bearish candle confirms the bear's dominance and the continuation of the downtrend. Chart examples highlighting the following three methods often point to situations where this pattern appears in a strong downtrend. For instance, consider a situation where a security has been in a clear downtrend for several weeks. A long bearish candle emerges, followed by 3 small bullish candles that fail to push the price significantly upwards. The pattern is completed by another long bearish candle that closes near or below the close of the first bearish candle. This sequence typically occurs with increasing trading volume on the bearish candles, reinforcing the likelihood of a continuing downtrend. The importance of surrounding market context cannot be overstated when interpreting the following three methods pattern. Factors such as market sentiment, trends in related securities, and broader economic indicators should all be considered. For example, if the pattern appears during a period of broad market bearishness or after the release of negative economic news, it is more likely to signal a continuation of the downtrend. In summary, the following three methods pattern serves as a reliable indicator of bearish trend continuation, supported by both its internal structure and external market conditions. Understanding and identifying this pattern can equip traders with critical information for making informed trading decisions, emphasizing the need to consider the broader market context for accurate interpretation. The following three methods pattern is a bearish continuation pattern that signals the continuation of a downtrend. To validate the significance of this pattern and reinforce its bearish implications, several additional indicators or conditions can be considered. First, trading volume plays a crucial role. Ideally, the volume should be higher on the days of the long bearish candles that form the beginning and the end of the falling three methods pattern. A higher volume indicates a stronger conviction among traders about the continuation of the trend. Conversely, the small candles within the pattern, which represent a temporary pause or pullback, should show lower trading volume. This difference in volume further validates the bearish continuation signaled by the pattern. Second, the presence of nearby resistance levels can also reinforce the pattern's bearish implications. If the pattern forms below a significant resistance level that the price has previously struggled to surpass, it suggests that the market sentiment remains negative and the resistance is likely to cap any attempts at a rally. This scenario underscores the strength of the bearish trend and lends more credence to the continuation signal provided by the falling three methods pattern. Third, the trend preceding the pattern is another critical factor. For the falling three methods pattern to be considered valid, it must appear within the context of a pre-existing downtrend. The pattern is a reflection of a brief consolidation phase within a larger bearish trend. Its appearance after a period of sustained downward movement indicates that the market may be taking a breath before resuming the primary trend. This continuity of the bearish trend before and after the pattern serves as a strong validation of its bearish continuation signal. In summary, when the falling three methods pattern is accompanied by confirming factors such as higher trading volume on the long bearish candles, existence below significant resistance levels, and a preceding downtrend, these conditions collectively strengthen the pattern's implication that the bearish trend is likely to continue. This comprehensive approach allows traders to make more informed decisions by considering multiple aspects of market behavior. The falling three methods pattern is recognized for its ability to forecast the continuation of bearish market movements with a reasonable degree of accuracy. This pattern, comprised of a long bearish candle followed by a series of smaller ascending candles and capped off with another long bearish candle, visually encapsulates a brief pause or consolidation within a downward trend. Over time, historical data has shown that this pattern reliably indicates that the prevailing bearish sentiment is likely to continue, providing traders and investors with a cue to possibly extend or initiate a bearish position in anticipation of further price declines. However, like all technical analysis tools, the falling three methods pattern comes with its limitations. Its predictive reliability is not absolute and can vary across different market conditions and asset classes. False signals are a reality where the pattern suggests a continuation of a trend that does not materialize, leading to potential losses. Therefore, it is crucial to use the falling three methods in conjunction with other analytical tools and indicators. Confirming its signals with additional analyses such as trend lines, moving averages, or momentum indicators can enhance its predictive power. Moreover, considering fundamental analysis to grasp the broader market context can provide a more comprehensive view, supporting more informed decision-making. In essence, while the falling three methods pattern serves as a valuable tool for identifying potential bearish continuation scenarios, it is most effective when used as part of a diversified analytical approach, incorporating multiple dimensions of market analysis to mitigate the risks associated with reliance on a single indicator. To integrate the following three methods pattern with other technical analysis tools for a more comprehensive market analysis, traders often combine it with the relative strength index, moving average convergence divergence, and Fibonacci retracements. These combinations provide multifaceted insights, enhancing the ability to make informed trading decisions. Firstly, integrating the following three methods pattern with the relative strength index, or RSI, involves watching for the pattern's occurrence alongside an RSI reading below 30. This combination suggests not only a bearish continuation, but also identifies potential oversold conditions, signaling a strong confirmation for the bears. Secondly, pairing the following three methods pattern with the moving average convergence, divergence, or MACD can be very effective. Traders look for the pattern while the MACD histogram is below the zero line, and ideally, when a bearish crossover, the MACD line crossing below the signal line has occurred. This reinforces the bearish market sentiment and continuation of the downtrend. Thirdly, Fibonacci retracements can be used to pinpoint potential support levels during the occurrence of the following three methods pattern. If the pattern develops near a significant Fibonacci retracement level, such as the 61.8% level, it might indicate a strong level of resistance to any bullish pullback, thus confirming the bearish sentiment. An example of successful integration in real-world trading includes a scenario where a trader identifies the following three methods pattern on a daily chart when the RSI is below 30, and the MACD shows a bearish crossover below the zero line. Additionally, if this pattern formation occurs near a key Fibonacci retracement level, the trader has multiple layers of technical indicators suggesting a strong continuation of the bearish trend. In such cases, traders might consider initiating a short position to capitalize on the anticipated downward movement, setting stop-loss orders just above the pattern's high to manage risk. Common errors and misconceptions traders often have regarding the following three methods pattern include misidentifying the pattern due to a lack of clear downtrend preceding it. This pattern signifies a continuation of a bearish trend and requires a strong initial downward movement. Without this context, the pattern may not hold its predictive value. Another frequent mistake is confusing small price moves within the pattern as a reversal signal. The following three methods pattern consists of a long bearish candle, followed by three smaller ascending candles within the range of the first candle, and concludes with another long bearish candle. The three smaller candles should not break above the high of the first long bearish candle. Misinterpreting these small upward movements as a bullish reversal can lead to premature or incorrect trading decisions. To improve pattern recognition and analytical skills and avoid these mistakes, ensure that there is a clear and strong bearish trend before the formation of the following three methods pattern. The presence of this pattern in a well-established downtrend is a key criterion for its validity. Familiarize yourself with the specific characteristics of the pattern. The first and last candles should be long and bearish, while the three intervening candles are short and can be bullish or bearish, but must remain within the range of the first candle. Pay attention to volume as it can provide additional confirmation. Typically, volume is higher on the long bearish candles and lower during the formation of the three smaller candles. Practice with historical data. Examine past charts where the following three methods pattern occurred within a downtrend to gain a better understanding of its appearance and implications. Keep learning about other candlestick patterns and technical analysis tools. A comprehensive understanding of the market and various analysis techniques enhances your ability to interpret patterns correctly. Taking these steps to heart will help in honing your ability to recognize and correctly interpret the following 3 methods pattern, thereby making more informed trading decisions in bearish market conditions. When employing the following 3 methods in setting entry and exit points for trades, traders approach this bearish continuation pattern with a strategic mindset. The following 3 methods pattern consists of a long bearish candle, followed by 3 smaller bullish or bearish candles that do not exceed the range of the first candle, and is completed by a final long bearish candle that breaks below the first candle's low. This pattern indicates that despite a brief consolidation, the overall bearish trend is expected to continue. To utilize this pattern for making trading decisions, traders often set their entry point just below the low of the final bearish candle in the pattern, as this confirms the bearish trend continuation. This entry point is chosen because it demonstrates that bears have regained control and are pushing the price further down. As for the exit strategy, traders might set a stop loss just above the highest point of the 3 smaller candles in the pattern to limit potential losses if the direction unexpectedly reverses. For taking profit, traders might calculate the height of the pattern and project it downwards from the entry point to estimate a target. There have been case studies where traders have effectively utilized the following 3 methods in their trading strategies. For instance, a trader once monitored a well-known technology stock that exhibited a clear downtrend on the daily chart. Upon identifying a falling 3 methods pattern, the trader decided to sell the stock short just below the low of the final candle in the pattern. By setting a strict stop loss above the pattern's high and calculating a profit target based on the pattern's height, the trader managed to secure a profitable exit once the price action confirmed the continuation of the bearish trend. This case demonstrated how the following 3 methods, when combined with prudent risk management techniques, can bolster successful trading strategies in bearish market environments. The following 3 methods is a bearish continuation pattern found in candlestick charting, primarily used in technical analysis to predict the continuation of a current downtrend. This pattern is composed of 5 candles. A long bearish candle followed by 3 small bullish or bearish candles that stay within the range of the first candle, and concluded with another long bearish candle that closes below the first candle's low. This pattern signifies that, despite a slight recovery or consolidation within the downtrend, bears are still in control and the downtrend is likely to continue. Variations of the following 3 methods include the rising 3 methods, which is its bullish counterpart, and several other patterns that share similarities in terms of market psychology but differ in their formation and implications. The rising 3 methods consists of a long bullish candle, followed by 3 small bearish or bullish candles that are contained within the range of the first candle, and ends with a long bullish candle that closes above the high of the first candle. This pattern signals the continuation of an uptrend. Another variation is the 3 white soldiers, a bullish pattern indicating a strong reversal of a downtrend. It features 3 long bullish candles, each opening within the previous candle's body and closing at a higher level. This pattern shows the gaining momentum of buyers. The 3 black crows is a bearish counterpart to the 3 white soldiers. It consists of 3 long bearish candles, each opening within the body of the previous candle and closing at a lower level. This pattern indicates the growing strength of sellers and potential reversal of an uptrend. For a vivid depiction of these variations, imagine the falling 3 methods as a small valley enclosed by 2 tall cliffs. The valley represents a brief pause or consolidation in the market movement before the downtrend continues, evidenced by the drop off the second cliff. In contrast, the rising 3 methods can be visualized as a small dip between 2 peaks, where the climb to the second peak signifies the resumption of the uptrend. The 3 white soldiers and 3 black crows can be pictured as a series of ascending or descending steps, respectively, each step representing a day of strong buying or selling pressure, indicating a change in market direction. In different market contexts, these patterns help traders to make informed decisions by indicating continuation or reversal of trends. It's important for traders to combine these patterns with other forms of analysis and indicators to improve the accuracy of their predictions.